risk because the companies were not able to manage their risk properly. They have gone into bankruptcy, or they had to shut down their business operations, or they had to be bought over by someone else. So such kind of disasters have occurred probably after 1990s. Most of the stories that we are seeing are the very recent ones. So some of them are in even in the early 2000s, and some of them being in the 90s, where the derivatives market probably has just started, and because of some things handled wrongly, the companies have lost out on their operations. So probably we need to understand those kind of scenarios also. Sometimes it may look very small in the current juncture, but when the derivatives were pretty much new, all these kind of speculation activities have happened, which has resulted in a lot of disasters for the companies. Even in some cases, they have lost to the extent of $1.5 billion. So that is the size of loss, which means probably some derivative transactions, if used for a speculation purpose instead of a hedging purpose, could result in such kind of damages also to the company's financial numbers. So the first of that is a case study of Drysdale Securities with Chase Manhattan. See, probably if we look at the case, it's a very simple scenario where the Drysdale Securities have actually borrowed some amount from Chase Manhattan, $300 million. But now, okay, borrowing a company, an investment bank or investment company or a securities company borrowing 300 million is not a big deal. But the key things there are the worth of the company is only $20 million. But Chase Manhattan has actually lent them $300 million. So almost 15 times the size of the company itself was the amount of borrowing. That's one key aspect. Then what we are also saying, what did they do with this 300 million? This 300 million, the Drysdale government securities, they have invested in various bonds. They have taken the various positions in the bond. So basically, like, they have gone into the some long positions, or they have purchased some bonds. Their values, if they go up, probably they are gaining. But what has actually happened in reality was there was a decline in the value. So if there is a decline in the value, that $300 million started losing more and more heavily. And because the company doesn't have a proper equity backing also, even if they lose by $20 million, even if the 300 million, if it becomes 280 million also, probably the bank is forced into the company will be forced into bankruptcy, because the equity position will be almost zero by that time. So they are almost forced into bankruptcy. But the key thing is, it's not the Drysdale which had lost badly. It's the Chase Manhattan that has lost badly, because in this deal, Chase has acted as the investment banker. So along with advice, it has also acted as a broker in the entire transaction. So as a part of that transaction, it has the responsibility for any payments that are due from Drysdale. So Chase Manhattan had to write off all those losses, and it has gone into big losses. But what are the key things? Okay, what is the fraud side of it? Okay, on one side, there was a market risk, because there was a decline in the value of the bonds, which has resulted in a loss. But apart from there is a big operations risk that was involved in the process. What was that operations risk? The system that has been used to value the collateral was a flawed system. So collateral was always valued without the accrued interest. So probably when let's say we are talking about a bond, right? A zero coupon bond purchased at 600, maturity value 1000. Now, while taking collateral, the value of that was taken as 1000, but not, or from a buyer standpoint, the value of the collateral was looked at as 600 only, but the accrued interest during the period was not included as a part of the finding out the value of the collateral. So the value of the cash position, whatever was the loan that was granted, versus the value of the collateral, there was a huge gap between the two. So because of that, the collateral was very much insufficient for the chase. So and the system which has been used, the formulas or the model that has been used, because there was a flaw in the way it has valued the collateral, and because of that completely misleading reports have come. Even in our data related quality issues which we discussed yesterday, we said a wrong formula can result in wrong reporting. Wrong reporting could result in wrong decisions. This is what exactly is the scenario. They have used a wrong formula to value the collateral. So though they have thought that they have taken the collateral, it is as if they didn't have any kind of collateral. So it's more of unsecured kind of securities rather than calling them as secured ones, because of the insufficiency of the collateral. So what has typically happened in the whole process? Even the thinking process was different. Chase thought that it was purely an advisor. But as a part of the deal, it was also mentioned that Chase will be responsible for collecting all the payments due. So if the payments are not collected, Chase has to write off all those things. So that was there as a part of an agreement which Chase was not aware of. So because of all these things, there was a huge loss, and probably this was one of the oldest case studies of the list of case studies which we are looking at. So during that time itself, this kind of risk-based lessons have come up, wherein the key lesson says use more accurate method while valuing your collaterals and based on what loan you are typically thinking of giving, and come up with a proper risk control function. Set up limits, right? Evaluate what is the worth of that company. Based on the worth of that company only give appropriate loan. Never give more than the size of the company or much more than the size of the company kind of loan. All these things come out as a part of the lessons out of this case study. Then we have the next one called Kidder Peabody. Again, this is a full fraud based case study, wherein what we see is a series of trades which are misreported. How did the misreporting happen? It's a very interesting thing. The misreporting has happened with respect to the government bond securities. The person who was in charge of the government bond trading desk, the way what he had done is, the spot market and forward market, time value of money was ignored for the forward pricing transactions. So basically we had to use the forward price as S0 into E per RT, right? So it was said that he has removed this E per RT part. So even the forward price, as per the calculation, see, let's say it's as simple as this. Let's say I have got into the spot market today. The price of some commodity in the spot market is $100, and in the forward market it is $105, right? This guy, what the system what they have used is, it directly records the profit of 5, because it ignores the time value of money. See, probably when I am saying 1 year forward exchange rate or commodity or whatever it is, spot market 100, 1 year forward 105, which means after 1 year it has to actually, even the spot price will approach the forward price after 1 year. But what this system was doing was, it directly computed that 5 as a profit. No time value considered. So that that difference was directly considered as a profit. And now long-term forwards will always be at a very high price, because if you go with the formula of S naught into E per RT, the same thing would have become probably 100 into some number. So it could have even been available at 120. So buying at 100 today or 120 after 2 years may not be anywhere different. So actually, literally speaking, the profit is zero there. But the system which these guys have used shows the profit as 20 without considering the time value of money. And that was the biggest flaw. So that's where he is saying that the company was showing an artificial profit of $300 million, $350 million. Just by showing the difference between, so they have entered into all forward contracts, right? 1 year maturity, 6 months expiry, all these kind of various long-term forward contracts they have entered into. And whatever was the forward price minus the spot price, instead of taking the present value of the forward price to compute the profit, generally when in FMP, when we have tried computing the profit at a particular point, value of the forward transaction or value of the future transaction, the computations which we have used were find out the present value of the forward minus the spot, or spot minus the present value of the forward. But these guys, they did not do the present value of the forward. They directly took the forward price minus the spot price. Every time it will be profit only. There is a very rare occurrence that there will be a loss in that transaction. So all those are reported as profits. And they did not consider the present value of the forward contract, which has resulted in huge profits coming up. And that too, especially when you are increasing the size of the contract, means S naught being a very high number, and also length of the forward T being a very high number. If you are using these two are very, very high, the difference is coming out to be significantly bigger. So whatever the profit that it was showing in their financial statement,